Hey guys, my name is Aliu Justonia. Today is the 11 of 30-day series where I promise to teach you Forex trading from zero to hero using ICT trading concept completely free. We have successfully completed Module 1 where we focused on mastering technical analysis using ICT concepts. Now we stepped into Module 2 where we will be diving into one of the most critical pillars of trading, which is risk management. Ha! Risk management is what protects your capital and keep you in the game long enough to achieve consistent profitability. No matter how powerful your strategy is, without proper risk management, losses are inevitable. Yes. So stay focused. Take note of every step because they are all connected. And let's get started. So this is our table of content for risk management. We are going to discuss about risk management, risk exposure or tolerance, risk versus reward, stop loss, leverage, lot size, pips. Yeah. So what is risk management? Risk management in Forex is the process of controlling potential losses by using tools like stop loss orders, proper position sizing, and careful use of leverage. The goal is not to remove risk, but to keep it manageable and protect your capital so you can trade consistently over time. So let's start with this risk exposure or risk tolerance. If we set risk exposure, like it is amount of money that you are going to risk per trade. So risk exposure determine how much of your capital you are willing to risk per trade. Usually, for conservative traders, like from 1% to 10%, that's maximum for those that want to go easy. But for aggressive traders, like they will risk like more than 10% to 100% because there is some they can even risk 100% of their account because they want to flip it. But the problem of that flipping is if you hit SL or if trade goes against you, that means you are going to blow that money. You are going to lose your account. So that's it. So avoid overexposure if you are a conservative trader by limiting your total open risks across multiple trades. For example, like me, I'm a conservative trader, so I risk like 1% for my funded account. But for my live account, my real money, I risk 10%. For example, if I will put like $100, I will risk $10 to trade. If I will put like $1,000, I'm going to divide it into 10. Like I will risk like $100 per trade. So manage correlated pairs, e.g., Euro USD and GBP USD or Euro JPY and GBP JPY carefully to prevent duplicate risk. For example, Euro USD and GBP USD, they are going in the same direction. So you should avoid, taking trade on both of them at the same time. And you are risking, maybe for example, if you are a type of person that like risking maybe 1%. So if you are going to take a trade on both Euro USD and GBP USD, you should like risk zero point 0.5 on both of them. Because if one hit SL, the other one is going to hit SL. If one is a winning trade, the other one could be a winning trade. So that's it. But if you are okay with risking maybe 1% on or both of them, that means you are prepared to lose maybe 2% if the trade is a bad trade. But if it is a good trade, you are going to win on both of them. So not not like understand how to protect your trading capital and maintain long-term sustainability. That's what risk exposure is all about. So risk reward. The risk to reward ratio measures potential gain versus potential loss. A good benchmark is at least 1 to 2. Risk, for example, let's say you risk $1 to make $2. But me, I prefer like to risk $1 to make $3. Because as I said earlier, no matter how good your technical analysis is, you cannot avoid like losing. You cannot avoid hitting SL. So for example, if you took like maybe 10 trades and you lose like 5 of them and gain 5 of them. So if you master how to use this risk reward, so that means even with 5%, even with 50% win rate, you can still be a profitable trader. Because if you lose 5 times, maybe you are risking $1, that means you are going to lose $5. But if you win like maybe 5 times, that means you are targeting three, like you are targeting 1 to 3, 1 to 3. So that means what, like $15. So from $15 you minus $5, that means you still have $10. You are still a profitable trader. So higher risk reward setups, for example, like 1 to 3 or more, allow for profitability even with lower win rate, what I just finished explaining. So learn how to structure trade that deliver consistent profitability over time. So stop loss. Always protect your trade with a stop loss. It is your capital insurance. Place stop loss beyond liquidity structured or structure point, not at obvious retail levels. Let me show you. For example, you have this, you are trying to take trade when market come back here. So you should put your stop loss somewhere around, maybe here, maybe somewhere around here. Because because if your setup is correct, if you are right about your setup, market can never go beyond this. But if you are wrong, market goes beyond this. So instead of allowing market to chop everything in your account, so it will just like push you outside and protect your capital. So this is what I mean. So place strategic stop losses that align with market structure and liquidity principles. Avoid moving stop loss impulsively during trade, even though there is some scenarios that you need to move your stop loss. Maybe when we start psychology under trade management, I'm going to show you where you can be able to move your stop loss. So what I want you to understand here is, if you have a bigger stop loss, that means your lot size is going to be small. That means smaller lot size. But smaller stop loss, that means bigger lot size. I'm going to talk about lot size, so don't be confused. And that is what we call leverage. So leverage in Forex is a tool that allows traders to control a bigger trade size, like a bigger trade size using a small amount of money. In simple terms, leverage is like trading, borrowing like trading power from your broker. As I told you from, I think, from our introduction, before, we retail traders cannot do forex trading. It is not designed for us. But later on, with a presence of brokers, we can be able to do those things, because brokers, like, they will take your small money and convert it into larger capital for you, so that they will connect you with a market makers to trade. So it helps leverage, like, that's using this leverage. So it helps traders open large position even if their account balance is small. But however, leverage is a two-edged sword. It can increase profit very fast, but it can increase losses very fast. Because at the same time, if market goes in your favor, you will make money very fast. And if market goes against you, you will lose money very fast. So if the market moves against your trade, your account can be wiped out, quickly. So that's it. Still on leverage. If you have, for example, like $100 account, if you have like $100 in your trading account and use 1 to 100 leverage, you can control a position worth like $10,000. Yes. So not small market movement in your favor, that means big profit. Small market movement against you, that means big loss. That is why risk management is very important when using leverage. So how are we going to use this leverage? By using what we call lot size. So what is this lot size? Lot size is lot size position size determine how much you risk per trade based on account size, stop loss distance, and risk percentage. That is risk tolerance. How much are you willing to risk? So calculate the correct lot size to control exposure precisely. That means how are you going to calculate your lot size? So this is the simple formula for lot size. As you can see, like, let me just tell you the truth. This table that you are seeing in front of you, you just have to just climb it like this. Just climb it and make sure it is inside your head. Because every time you are trying to calculate your loss size, you will be remembering this table. It will help you to calculate your loss size, efficiently. So let me just go and explain. So the first class that we have on lot size, we have what we call nano. Nano, it has units of base currency like 100. For example, if you put $1, they are going to times it times 100. So which lot size are you going to use for like that level? Is going to be 0.001. I'm going to explain. I'm just trying to read this table to you. It's 0.001. And if you use this lot size to trade, that means like for every market movement in your favor, you are going to gain like 0.01 cent. And if market move against you, okay, the other one in your favor, if market moves in your favor, that means you are going to gain 0.01 cent. But if market moves against you, you are going to lose 0.01 cent for every market movement per pip. I'm going to explain pip. So the second one is micro lot, which it has unit of base currency of 1000. That means if you put $1 in your account, if you trade using $1, that means you are going to what? Or let's say if you are risking $1, let's make it that way. If you are risking $1, that means that $1 they are going to times it times 1000. So that means which lot size are you going to use to get this kind of unit of base currency? That means you are going to use what? 0.01 lot. So if you use 0.01 lot, how much are you going to be getting if market moves in your favor, and how much are you going to lose if market move in your what? Against you? That means you are going to be gaining 0.1 cent if market moves in your favor. If market moves against you, you are going to lose 0.1 cent per pip movement. So the third one is mini lot. So mini lot, it has 10,000 unit of base currency. If you want to use this mini lot, which lot size are you going to use? You are going to use 0.1. So 0.1, if market moves in your favor, you are going to get $1 per pip. And if market moves against you, you are going to lose what? $1. That means the higher lot size, the higher gain or the higher loss. So we have this standard lot, which it has 100,000 of you, like 100,000 of unit of base currency. So how are you going to use this kind of lot? That means by using one lot size. So if you are using one lot size, you will get like you will get what, $10 if market moves in your favor, and you will lose $10. Imagine your account is just $10, and you go ahead and put this one lot. That means just one movement, it will just pack that money, and just one movement in your favor, market will give you, you know, times two of what you have. So how are you going to calculate like this loss size based on your account type? Because you are going to calculate it based on, let me just go to my chart, maybe it will I will it will what I'm trying to say is that, let me do I have, why is XAUSD? XAUSD. Let's say for example, let's go back to 4 hour. So this is the trade that analysis that I did, and this is the trade that I took, even though I have not updated you. So for example, this is the what? This is the trade. I enter market from here, from this order block. This order block. So from here to here, this is where my stop loss is. That means if market move against me, so when it reach here, market will stop me out of the market. So like everybody has its own stop loss based on their account size. There is somebody that if market goes in his, like goes against him, from here to here he is going to lose maybe $10. And the same time, somebody from here to here he is going to lose only maybe $1, somebody $100, somebody $1,000, somebody $10,000. It depends on your account size. So how are you going to tell the market from here to here, I want to lose only $1,000, or I want to lose only $100, or I want to lose only what? Only $10. How are you going to tell market all those things? That is by using what we call what? By using what we call let me quickly write this down here. By quickly using this formula, uh this is the formula. We have lot size. Lot size is equal to risk tolerance. Risk tolerance Risk tolerance divided by what? Risk tolerance divided by SL. But that your SL, you want to calculate it in pips. As I told you earlier, I'm going to have a special class for you for pips. So and both the result, like when you get the result, then that result you can divide it by 10. So that is your loss size. So how are you going to get your what? Risk tolerance. So risk tolerance, our risk tolerance, if you could remember, I discussed about risk tolerance, I think from the first or second slide. Risk tolerance is equal to what? The money that you are willing to risk. For example, if your account is $100, let's say $100, you divide it by 10, which is going to give you what? $10. If your account, it depends on how much you are willing to risk. Maybe somebody can say maybe he just want to risk maybe $1. That means that $100 you are going to divide it by what? 100. Or maybe you want to divide it by 20. If you divide it by 20, that means you are going to be risking $20 per trade. Or maybe you want to uh, okay, by 20 sorry, by 20 that means $5. If you said by 5, that is 20 dollar. So let's say I want to I want to risk $10 per trade. I want to risk $10 per trade. My account size is what? My account size, let's say my account size is maybe $100. My account size is $100. And I want to risk like 10% of my account. 10% of my account is what? That means my risk tolerance is 10%. So 10% of $100 is equal to what? Is equal to $10. So that means $10 is my risk tolerance. Then the second one is stop loss, SL, in pips. So how am I going to get my stop loss in pips? This is my stop loss in pips. So you will get your stop loss by from here to here. So this is what? This is um this is my stop loss. This is that middle number, 4,559. These are my what? Stop loss in pips, which is let's say 4,000 five five 9,000 like pips. So our SL in gold is what? Is I shouldn't even supposed to start with gold, because there is some things that I need to tell you about calculating of um um there is something that I need to tell you about loss size calculation on gold. But let me just start with let me start with GBP USD. Let's say for example, um I want to take a trade from here. Maybe this is this order block. So I want to take trade from, maybe I want to sell this. Maybe here should be my stop loss, for example. So with the same account, that is $100, and as you can see, my stop loss here is just 18 pips. That is from here to here, 18 pips. As I said earlier, I'm going to discuss more about pips for you, so don't be confused. Pips, let me just say it in brief. Pips is like another way of measuring price movement. For example, like those that are selling like plot of land, they are using like feet to measure like the size of the land, right? And like the road, like they are using kilometers to measure the distance between social state and social state. They are using kilometers, like, right? Some they are using miles. So the same thing for traders, they are using pips. So I'm going to explain more on that pips. So from here to here is what? So there is more ways to measure from to like there is so many ways, sorry, there is so many ways to get the pips from social area to social area. So the most common one is using this position tool. This position tool, it can give you like it can give you your stop loss in pips, that is from here to here. As you can see, it 18.5 pips, and my target from here to here, which is 84 pips, 84 pips. So, and there is another way, which is this price range. If you take it like from here, let's say from here to here, you can see it will give you like the pips if you can put it correctly. As you can see, 18 pips. So that means our stop loss is going to be, let's say, 18.5 pips, and we are risking what? We are risking $10. So what is our formula said? Loss size is equal to what? Risk tolerance. What is our risk tolerance? That is $10. Then stop loss in pips. What is our stop loss in pips? That is 18.5. So let come and do our calculation. So loss size is equal to, let's say, $10, $10 divide by what? Divide by 18.5. Let me use my calculator. So let's put the calculator here. So let's say $10 divide by what? Divide by 18.5, which give me 0.54. So then to complete the calculation is, I'm going to divide the entire result by 10. So divide by 10. Divide by 10, that means it's going to be 0.05. That is my loss size. So this is going to fall under which category? It's going to fall under what? It's going to fall under micro lots. Micro lot, because 0.05 is fall under. That means you are going to have what? 5,000 unit of base currency. You are going to use 5,000, because if you said 1,000 times 5 is going to give you 5,000. So that's it. So let use like let use um let's use like lot size calculator. We have like some lot size calculator here. Sometimes I use this, fundednext.com/calculator slash lot size dash calculator. So let's say GBP USD. We are going to validate if our calculation is correct. GBP USD. So our account size, let's say $100, right? Then we are risking what? 10%. So, but this one, you cannot use like pips directly. You have to give them your entry price and exit price. They will calculate their pips by themselves. So let's give them the coordinate. So the coordinate, let's take it from here. So this is our entry price, and what? Stop loss. Here is our stop loss. That's exit price, where we want price to kick us out of the market if we are wrong. So as you can see, 0.05, which means our calculation is correct. 0.05. So we are going to remove these things here. As you can see, so our calculation is correct. So that's how you are going to do your calculations for. This is the formula. Lot size is equal to what? Risk tolerance divided by stop loss in pips divided by 10. So what is our risk RT is equal to our risk tolerance. What is our SL is equal to stop loss in pips. So this is how you will calculate your this is how you are going to calculate your loss size for if you are trading maybe like currency pairs, GBP JPY, USD, USD JPY, GBP, every currency pairs. This is how you are going to calculate their loss size. But there is some small changes if you are trying to calculate it for like some high volatility assets like XAUUSD, which is gold, BTC, US 30. So there is there is a some changes. How what is that changes? So you are going to divide the number by 10. That is how you are going to use your stop loss in pips. Let me explain so that you will understand more. So let's go back to here. Let's go back to our gold. XAUUSD. So as I said, this is what this is our pips. How did we got it? We got it from here, as you can see, 4,559. So you cannot use this exactly to calculate your loss size. So you are what you have to do first is you have to divide this by 10. So what is the result? Let's delete this. Let's divide the number by 10. So I think we are going to get what? Sorry, 10? Yes, 10. So let's divide it by 10. So where is our calculator? If we said 4,559, let's say divided by 10, which is 455.9. 455, that's 455 and 0.9 pips. So this is going to be our what? This is going to be our stop loss. So how are we going to do our calculation in this matter? So we are going to set what? Um, SL, our SL is equal to our $10, our beloved $10, $10, let's say divided by 4559, right? So let's go back to our calculator. Let's say 10 divided by 4559, which is going to give us what? 0.02. So let's say divided by 10, which is going to give us this. So that means $10 is not going to be enough for us to, trade gold, because like this thing is going to fall under which category? 0.002, which is which category? Which is which category? Nano. And there is a lot of brokers actually that they are not, like, they don't support this nano. It's just that I decided to show this nano to you for educational purpose, even though there is some that are still uh supporting it, but most of brokers, like, they don't really support nano. So that means with your $10 you cannot trade gold properly under like 15 minutes. Maybe you have to go down to, let's say, like 1 minute for you to be able to trade gold. So let's go down to 1 minute. Let's go down to maybe 1 minute. Let's go down to 1 minute. So let's assume, let's take this as our what? As our dealing range where we wanted to trade gold from, because gold, it has like high volatility. So that is why, like, that your $10, like, is not enough to trade gold in 15 minutes if you want to apply risk management properly. So let's say this is our SL. So our this thing is going to be what? Our SL from trading view position tool is going to be 1000 and 61. So let's say 1061 divided by 10. 1061. Where is my calculator? Okay. So 1061, let's say, divided by 10, which is equal to this. 106 106. I think it has a decimal number. uh 1. So let's use our calculator again. So let's say our $10 divided by 1. So let's say this divided by 10. It still fall under this. So let make this $30. Let's say we want to risk, let's say $30. Let's say we want to risk $30. $30 divided by 106. So let's say divided by 10. That means this result, the result that we got here, divided by 10, divided by 10 is going to be 0.03, because if we abbreviate this to this, that means 3. So it's going to be 0.03. So that means we fall in which category? We fall under what? Under micro 0.03. That means we are going with 3,000 unit of base currency. So let's go and calculate it using um, using position calculator, lot size calculator. Let's see. So let's select XAUUSD, XAUSD. So in this aspect, we are what? We are risking 30% of our 100 account. So let's take the coordinate. Entry price, uh, SL, as you can see, we are correct, 0.03. So our calculation is correct. So this is how you are going to calculate your loss size, even though the video is kind of getting longer. So let me just move to the next topic. So that's how you are going to do for XAUUSD, which is gold, BTC, US 30. So you will divide that number by 10. But on NAS 100, which is uh, NDX 100 on some brokers, divide the number in the middle by 100. That's how you are going to get your SL in pips. So, and you can use lot size calculator as well, the one that I just finished showing you. So that's it for lot size calculation. And then that is pips. So we are here to discuss about pips, but the video is kind of long. So I think I'm going to do a second video for pips for you. Or I think let me just see if I can be able to explain the pips in this video. Maybe pips. A pip is equal to percentage in point, or price interest point, measure price movement. As I told you earlier, that's how you are going to measure price movement. The unit of measurement to express the change in value between two currencies is called a pip. Understanding pip value helps determine profit or loss. So how are we like this is pips calculation. So like every pair, every commodity or every asset, like it has its own way of like calculating its pips. So let's take Euro USD like the standard pairs, Euro USD or GBP USD. How are we going to calculate it? Pips. So as you can see, this is the example of price like 1.32919. This is the example of Euro USD price or GBP USD price. Like it has one whole number and then it has decimal number like how many like five of them. Yeah, so how are you going to start calculating? You should start from the second to the last number. Like anytime this number change, that means market move with 1 pip. Somebody will ask, what about the first one? The first one, we call it what? Pipette. It is a fraction of a pip. That means this number must change from 0 to what? 9 before, like to 10 before it will give you 1 pip. That means it's like countdown for like time. Like after like 60 seconds, that means 1 minute. After 60 minutes, that means 1 hour. So that is how the this pipette works. So like from 0 to 10 pipette, it what make 1 pip. So that means from what? 1 pip is equal to the like fourth decimal place number. That means from what? One, two, three, four, which is one. That means if one change here, if this change, that means what? 1 pip. If like this change to 10, like from 0, let's say 0 to 9, 10, that means this will change. That means what? 10 pip. After this change, like when this change, that means 10 pip. When this change, 100 pip, 1000 pip, 10,000 pip. Yes, that's how it is. So JBP, what about for JPYPS? For JPYPS, so JPYPS, something like USD JPY, Euro JPY, GBP JPY, like their prices. This is like the sample of their prices. So how are you going to start counting the pips? So almost the same thing with this. So you will start with the what? So 1 pip is equal to like 0.01, which is like the number one, like the second decimal place. If you start counting from the decimal place, one, two, so like the same thing, like this six, you it is like the last digit, last digit 6 is a pipette fraction of pip. The same thing with this. So when this change, that means 1 pip. When this change, that means 10 pip, 100 pip, 1000 pip, 10,000 pip. So that's it. So it is not something difficult. So let's go to, I think I have more samples. And for gold, it has some like some things there. For gold, second decimal place is 1 pip. Through some brokers use like first distance. For example, I think this one, like if 1 pip is equal to second decimal place, which is 0.01, most common, like most of brokers that we have today, like This is the example of the price. For example, from here, it will start counting from here. Like for some brokers, like they don't have that pipet here. So it will start counting from the last number. When this change, like 1 pip, 10 pip, 100 pip, 1000 pip, 10,000 pip, 100,000 pip. So for gold, for some brokers, so 1 pip is equal to 0.01, and the second, like 2, which is this, is 1 pip. If there is an extra one digit, for example, maybe some brokers you might see something like this. Instead of just two numbers here, you will see like three numbers. So like this last one, the last digit is pipet for this. So, and the second option is if 1 pip for gold is the first decimal place, which is 0.1. Some brokers, I think my broker also is like this. So, which is um like the what, this the second, this thing, okay, the first decimal number, so which is this, and the second one is pipet, fractional pip. So which is 1 pip is equal to what, 0.1, and the what, number 3 here, based on this example. Just take it very easy. You don't confuse yourself. Just take it very easy. So this is it for gold. Like what I'm trying to tell you is that, like gold, it has two options for reading their pips, and it depends on the broker that you are using. You understand? So that's it. The first option is some they start counting from the second decimal place, and the second option is like they start counting from the first decimal place. Like it all depend on broker. But my broker personally, my own broker, like they start from this second one. Like if you want to start counting from the what, from the second, is if you saw like this, it has like three decimal numbers. So that's when you will start counting from like the second one. But if the price that your broker is offering, like it is something like this, like my own, let me show you my own. As you can see, my own, it is like that. As you can see, like two decimal numbers. So the same thing with the second option. So it depends on how your own look like. So as you can see, this second one is my own. So the fifth one is indices, like something like US 30. Usually the first digit before the decimal place. So this is the example of how the US 30 price look like. So it has one decimal number. So that means this last seven, like this seven, is the pipet. So it start counting from this. So as you can see, so this number, when this change, for example, as you can see, this is 69. When it changed to 70, that means like this change from what, 10, right? That's why we have 70 here. So that means 1 pip. The digit before the decimal is what moves per pip. So the last digit, point 0.7, is the pipet, fractional of pips. So this is just very easy. So I give you this as like the like formula, like examples, so that you can understand how to read, like how to read pips. If you, by mere looking at the price, how to read pips, just the last number is the what, pipet, that's fractional pip. Then the second one is where the counting start from, which is 1 pip. you know that's how it is. So that's pips calculation. So this is the summary of everything in risk management. So risk management is the foundation of trading longevity. By controlling your exposure, reward ratio, and loss size, you shift from gambling to professional risk-based trading. Understand how to protect your trading capital and maintain long-term sustainability. So this is risk management for you. So I'm hoping you understand all these things that we did. So if you did not understand, or maybe you have a question, that's why I created a Telegram group for you. So you can just join my Telegram and reach out to me there to ask you a question. Or if you have maybe like question, or like you need more explanation, just reach out to me there. I will do the explanation for you. So don't forget, I'm going to put that my Telegram link on a description, and then I think the next class is going to be okay. So this is the end. So our next class is going to be what? Is going to be uh, fundamental analysis, which we are going to learn commitment of traders, COT report, which is very very important, and so many traders they don't know about this, and economic calendar, news impact on liquidity and volatility, interest rate. So those four topic, they are the topic that we are going to discuss in fundamental analysis. Like fundamental analysis is very deep, but this is the most common one that we are going to discuss. And then our last module is what? Trading psychology. So if you don't want to miss these classes, you can go ahead and follow me on my TikTok, which is Aliyu underscore Gistonia, or you can follow, you can subscribe on my YouTube channel, which is the same name, Aliyu underscore Gistonia, or you can go ahead and join my Telegram to ask your questions there. Or if I post new video, I normally keep my group members posted. So thank you very much for watching this video. See you in my next video, which is fundamental analysis video.